Hedge funds are alternative investment vehicles that employ a wide variety of strategies designed to generate absolute returns, manage risk actively, and exploit market inefficiencies. Unlike traditional mutual funds, hedge funds generally face fewer investment restrictions and can utilize leverage, short selling, derivatives, and concentrated positions. Their objective is often to produce positive risk-adjusted returns regardless of overall market direction. Hedge fund strategies can be broadly categorized into equity-based, event-driven, relative value, opportunistic, and macro-oriented approaches. Understanding the characteristics, return drivers, and risks of these strategies is important because hedge funds can provide diversification benefits and alternative sources of portfolio return. Equity hedge fund strategies focus primarily on stock markets and seek to profit from security selection and pricing inefficiencies. Long-short equity is one of the most common approaches, involving long positions in undervalued stocks and short positions in overvalued stocks. The strategy aims to generate returns from relative performance differences rather than broad market movements. Variations include market-neutral, short-biased, and sector-focused strategies. By combining long and short positions, managers attempt to reduce systematic market risk while emphasizing security-specific opportunities. The success of these strategies depends heavily on research quality, stock selection skills, and risk management effectiveness. Market-neutral equity strategies represent a specialized subset of equity hedge fund investing. These strategies attempt to eliminate broad market exposure by balancing long and short positions with similar market sensitivities. As a result, returns are intended to depend primarily on the manager's ability to identify mispriced securities rather than on market direction. Common techniques include pairs trading, statistical arbitrage, and factor-neutral investing. Because market-neutral strategies seek to isolate alpha generation, they generally exhibit lower correlation with traditional equity markets. However, performance depends on maintaining appropriate hedges and accurately identifying valuation discrepancies that eventually converge. Event-driven strategies seek to profit from corporate events that may create temporary pricing inefficiencies. These events include mergers, acquisitions, restructurings, bankruptcies, spin-offs, recapitalizations, and other significant corporate actions. Merger arbitrage is one of the most widely used event-driven approaches, involving the purchase of shares in acquisition targets and sometimes short positions in acquiring firms. The strategy seeks to capture the spread between the target's market price and the proposed acquisition price. Event-driven investing requires careful analysis of transaction terms, regulatory considerations, financing risks, and the probability that the anticipated event will be completed successfully. Distressed securities investing is another important event-driven strategy. Managers invest in the debt or equity of financially troubled companies that are experiencing operational difficulties, restructuring processes, or bankruptcy proceedings. The objective is to identify situations where market prices underestimate recovery values or turnaround potential. Because distressed investments involve significant uncertainty, managers must analyze capital structures, legal claims, asset values, and restructuring outcomes carefully. Although these investments can generate substantial returns when successful, they also involve elevated risks, including liquidity constraints, valuation uncertainty, and adverse legal or operational developments affecting the issuer. Relative value strategies seek to exploit pricing discrepancies between related securities while minimizing exposure to broader market movements. These approaches often involve identifying assets whose prices have diverged from historical or theoretical relationships and establishing positions that profit when prices converge. Common examples include fixed income arbitrage, convertible bond arbitrage, volatility trading, and capital structure arbitrage. Relative value managers focus on quantitative analysis, valuation models, and risk controls to identify opportunities. While these strategies generally target small pricing inefficiencies, leverage is often used to enhance returns. Consequently, effective risk management is critical to controlling potential losses during periods of market stress.